We're about an hour into U.S. trading session. Literally nothing to see here. Volume light. Stocks go nowhere to kind of wait for that Fed decision. Abigail's tracking the moves. Abby?
Yeah, the classic treading water ahead of the Fed. And this is what it looks like for the NASDAQ 100 futures overnight. Down a little bit, up a little bit. This looks like a big gain, but up just fractionally. And right now down literally a fraction as investors wait to see what is the Fed going to say today. Now, clearly the expectation is that they're not going to be moving rates, but will they give any color on the November meeting or the dot plot folks will be looking at? Let's take a look at the sectors since the last Fed meeting. This is pretty interesting. This is literally what we have since the last Fed meeting. 9 of the 11 S&P 500 sectors are lower. The only 2 sectors higher, energy up with oil, and then we also have consumer discretionary up about 3%. Take a look at tech, though, down 4.5%. This as the dollar and yields have absolutely shot higher. The financials, which should benefit from yields going higher, down 1.4%. And then the real rate-sensitive sectors, real estate and utilities, both down. These are the worst 2 sectors. As yields go higher, these dividends look worse. So stocks have not really performed all that well since the last Fed meeting. I think that folks were probably a little bit surprised that the Fed didn't officially announce a pause. Based on my hearing, I still think that that's where they're at. And this is interesting because if you take a look at the Fed funds rate, if you go into the Bloomberg terminal and use the world interest rate probability WIRP, it suggests that next year we're going to see anywhere between 75 bips to 1% of cuts. Fed Chair Jay Powell, to my ear at least, literally said that they don't see themselves cutting for a couple of years. So here's the pain that's taking some of the money out of the market, or a lot of money out of the market. Tightening conditions here, Guy, and it does suggest that we could have a little bit more pain ahead for stocks if the Fed doesn't ease off, which I don't think that there's any indication. If we have time for this Bloomberg terminal chart, we will see the S&P 500 right here since that Fed meeting, stuck in this range, a battle between the bulls and the bears. It looks like the last touch was to the top, which may suggest, again, we could see some of the near-term buyers step away, the near-term sellers step up and take that S&P 500 closer to 4,300 or so. But it will be interesting to see what happens later today.
What kind of a mountain are we climbing? That is the question we still don't know the answer to. When we get to the top, what are we going to see? Abigail, thank you very much indeed. Abigail Doolittle, what's happening in the markets? Investors certainly going to be watching the Fed very, very carefully a little bit later on. What will it say about the U.S. labor market? What will it tell us ultimately about where it sees inflation going, and therefore how is it going to respond? Michelle Meyer of Mastercard Economics Institute joining us yesterday. Here's what she had to say.
The number one factor that drives consumer spending and will drive this holiday season is the labor market. And there it has been a story of strength with continued job creation, continued turnover of the labor market, and wage growth that's running above normal.
Michelle Meyer joining us yesterday from Purchase, which is the best place for Mastercard to be based. That takes us back to our question of the day. Are we there yet? And I think you can apply this question to a number of different central banks. Rabila Faruqi, High Frequency Economics Chief US Economist, joining us now. A little quote from you that was in a Bloomberg article earlier on. This is Rabila Faruqi, the quote. "We think the Fed has delivered enough and the funds rate is sufficiently restrictive. But if the labor market does not soften and there are surprises, upside surprises on inflation, there is a risk that the Fed will have to push even higher." Rabila, great to see you. How big is that risk?
Great to be with you. We think, the U.S. economy is going to see, is going to moderate. Activity is going to moderate going forward. So we don't think that the risk is very high right now, but we do think that the Fed is in no position to say that, they are at the peak rate. We think they are at the peak rate. We think they've done enough. But the problem is that the economy is still not responding in a way that we would expect it to do over 500 basis points of tightening. This reacceleration in the third quarter, that is really problematic. And, what happens in the fourth quarter, I know there's a lot of headwinds, but we have consistently underestimated the strength of the economy and the household sector in particular. So that's something that we are watching very carefully. We don't think that there's a huge risk, but, we can't discount it completely.
So, Rabila, if the Fed may be there yet, but it's just the lag time is still the thing, what would the dots have to tell you to convince you that the Fed also thinks that they're there?
like I said, the Fed is not in any position to say that they're there yet. So I don't expect any change in the dots in terms of what they expect for 2023.
Well, but
They
about their
have to keep.
projections, Rubila? Like if they see unemployment go up like 1%, if they see inflation come down like are the projections where you need to be looking?
I think we need to be looking at the dots. I think that one more rate hike has to remain on the table. I think on unemployment, I think I don't expect any big changes to that forecast. And also on inflation, I think their projections for 2023, they're probably too high. So I think we might see some, downshift in that forecast. But, I think the whole point is that there's so much uncertainty about 2024. Like I said, we've underestimated performance of the economy, but we still think that the lagged effects of 500 basis points of tightening are going to filter through. We still think that consumers are going to face those, are facing headwinds. But the thing, as Michelle Meyer said, the labor market is still very strong, job growth is positive, and households are wages are rising at a pace that is elevated. So I think those things are still positive, and real incomes are now rising. Inflation is easing. So it's a very uncertain sort of time in terms of what's going to happen going forward. But we still think that the U.S. economy is going to avoid recession, growth is going to remain positive, and that inflation is going to continue to ease and towards that 2% target.
The problem with all of that is we're not going to know until we've got all the data. We're not going to know. This is all rearview mirror. We're not going to know if the Fed's made a policy mistake until kind of we're well into next year. And at that point, it could be too late. How big a risk is there at this point that the Fed does too much than too little?
This is why we are concerned. This is why we think they are at the peak. We think they have done enough. I think the further they push this, I don't think 25 basis points is really going to make or break this economy, another 25 basis point rate hike. But if they do continue to push against this, positive growth, they've consistently said they want to see growth slow to a below trend rate. That's just not happening, but we are seeing some softening in the labor market. We are seeing, movement in inflation in the right direction. So we don't think the Fed needs to do a lot more. We think the risk then rises quite substantially the further they push this and they continue to push the funds rate high into even more restrictive territory.
So, Guy, this is where I think the government potential shutdown here in the U.S. gets interesting, because if that happens, to me the biggest point is we're not going to get any data. And if you have data that doesn't come, then how do you manage November 1st?
How are you data dependent without any data?
Right. And then as a market participant, you may not care about the shutdown. That might not have an impact. But what do you do then when it comes to kind of where you're looking at ranges or volatility or anything?
Absolutely, it's going to be a huge problem. You've also got to throw the UAW into the mix as well. You don't know what's going to be happening. The effects of other central banks is going to be really interesting too, in terms of the effect that they're having in to the U.S. economy. So there's all kinds of factors in the mix here that I think make the next few months really, really difficult. Rubila, how would you characterize your degree of certainty right now?
About the U.S. economy or about?
Yeah.
Yeah, I mean, degree of certainty, we are very certain that growth is going to remain positive. We have been looking for a slowdown for some time to a sub 2% growth rate. That has just not materialized, and the economy has now accelerated. So the degree of certainty about positive growth is there. The degree of certainty about whether this third quarter momentum can be maintained, we're just not sure that can happen. We are also not sure, again, like I've said, the economy has surprised to the upside so many times. Our base case remains that we're going to see a pretty substantial slowdown in the fourth quarter, and that growth is going to be sub the 2% for the next few quarters.
All right, Rubila, thanks a lot. We really appreciate it. Rubila Baruchi of High Frequency Economics. Thank you so very much. Just an update here. Clavio, we are pounding the table until we get to the official opening here. It looks like the stock is indicated to trade at $34.36 right now. That's priced at $30. And I should point out that Instacart is still up 10% over the last 2 trading days, so fair enough. All right, coming up, we're going to take a look at what Fed moves actually mean for housing. So Mark Rayfield is president and CEO of Saint-Gobain North America. This is a great read on the ground. This is Bloomberg. question of the day today is, are we there yet? Are we there yet with central banks at their peak? So housing, probably hope so, or at least if you want to buy a house, you most definitely hope so. Guy, this is the moment, right? 7.6% is where we are with 30-year fixed on Bankrate.com. A lot of people locked in sub 3, and that is a really wide berth. And if you're looking to buy a house, it makes it extraordinarily expensive. And I realize that inventory is still an issue, but if you're looking to buy a house, and if you're a parent looking to offload your kid into a house, you want that rate to come down.
Okay, all I'm hearing now is the clock ticking to Alex going, let me tell you about the rate I got.
Yeah, I know. You're the one that always brings this up. It's 2.75%. I am emblematic of the problem that's with existing housing right now.
Sorry, we were talking about this in the break, because believe you me, this doesn't come about by accident. So there was an article in the Journal the other day about rate bragging. Is that true?
Yeah, but they call it subtle rate bragging, and my husband, we're talking about it, and he's like, do you do that? I'm like, it's not subtle. I just full out brag about it.
There's no subtlety. There's no subtlety here whatsoever. But you in some ways are the problem.
Yes.
Because you guys have locked in, you're all good to go, you're very happy, you're sitting there, everything's good, but you're not going to move houses anytime soon. And that's what's caused problems in the existing market, which is why we've seen obviously what's been happening in the new market.